Hi everyone, Hadar here from Property Genie. Today, this is the first video out of a series of 3 videos which we will cover explaining and going through the subject of return on investment. In this first video, I will cover the difference between net yield and gross yield. When you're buying investment property, it's fundamentally important that you will know exactly what sort of cash flow the property will generate. Is it cash flow positive or is it cash flow negative? And this simple calculation, which I'll guide you through now and will show you the examples how to calculate them, will make the difference from you to make an informed decision when you purchase an investment property. So understanding the difference between net yield and a gross yield is a very, very important subject. So without further ado, let's jump into it.
So here we are. This is the first chapter in our trilogy. This is chapter 1, understanding the difference between gross and net yields. We put this series of 3 episodes about return on investments as for your request. We hear you. We wanted to provide you with what you actually want to see. So thank you for the email and the requests for content. Let's go and see how to calculate the gross and net yields. Gross yield is simply an annual income divided by the dollar amount of the investment. If you had a property which was generating $30,000 per annum with a dollar amount of $300,000, this will be a 10% gross yield. If you had a property which was generating a different amount per annum, you take that amount of the gross annual income, just the rent, divide that from the property purchase price or the dollar amount of the investment, and that will give you a gross yield. If you calculate that and you receive the number equals 0 point something, you multiply that by 100 and that will give you a more whole number that will be easier for you to understand the yield. For example, if you had a property which was generating, the same property was generating $15,000 per annum, divided by 300,000, that gives us a gross yield of 5%. If you put it on a calculator, you will see 15,000 divided for 300,000, it will be 0.05. Multiply it by 100 and you will get 5 in the front, and that's the gross yield. Gross yield is quite a broad calculation. You should never rely on gross yield when you buy an investment property because it doesn't take into account any expenses, anything that would reduce the cash flow. It doesn't give you any indication of the possible cash flow of the property. So you really need to do at least the net yield, which is the next one. Net yield is an annual income minus all expenses divided by the amount of the investment. Typical expenses for the property: interest costs, which is the largest expense of any property investors, rates or land tax, insurance, maintenance, property management cost, could be various other costs as well, like lawn mowing, gas, warranty of fitness, depends on the property, but for this exercise let's keep those expenses. Remember, the annual income minus all expenses divided by the amount of the investment will give you the net yield. So let's give you an example for net yield. First, remember, purchase price of 300,000, annual rent, annual income, gross income will be $30,000 per annum. This is 10% gross yield. Now, let's start deducting the expenses. We have interest costs at 5%, $15,000. We have rates at $1,800 per annum. We have insurance at $800 per annum. Maintenance, $2,000 per annum. And property management cost at 10%, which is $3,000 per annum. Annual rent of $30,000, 10% of that management cost is $3,000 per annum. Rule of thumb, when you're calculating, this is just a tip, rule of thumb, when you calculating property quickly in your head and you want to see if it could be positive cash flow, if the interest cost percentage is half of the yield, it's very likely that the property will be positive cash flow, meaning if the gross yield is 10% and the interest cost is 5%, it's very likely that the property will be positive cash flow. This is provided the expenses component is not much higher than an example here or any normal expenses. For example, some properties do have a higher expense component like body corporate fees and what's called owners sinking funds in apartments and condominium, but that could be reducing the expenses or increasing the percentage of the expenses. But let's stick to that. So let's calculate all of those expenses sum up to $22,600. If you're taking the annual rent of $30,000 per annum minus the expenses, which is $22,600, it equals to $7,400 net income per annum. This is an actual cash flow of $7,400 per annum. So what will be the net yield on this property? The net yield would be the net income, which is $7,400 per annum divided by the $300,000. This is equivalent to 2.46%. This is low yielding, a low net yielding property, but provided you purchase the property with 100% finance, what would return on investment that be if you actually borrowed the whole lot with 100%? The return will be an infinite return because you don't actually invested of your own money. You're getting $7,400 per annum in your pocket without actually putting any of your own savings or money. We'll get to cover how to buy properties no money down in a different video, so keep up to date with us. But for this particular video, we're calculating net yield. So this is how to calculate net yield. You take the gross annual rent, subtract all the expenses, and divide that sum that you get by the property purchase price, and that will give you the net yield. Coming up next, chapter 2 in the trilogy is cash on cash return. That will be calculating how much return you get on your money if you put deposit in the actual cash deposit in any property you purchase. And chapter 3 will calculate the internal rates of returns, the IRR. That's the most fascinating return on investment, when you can see the property performance over a period of time, taking into account capital gain and rent increase and various other things. So stay with us. Feel free to ask any question or post any comments below. Subscribe to our channel so you can keep up to date with those other chapters coming up and more videos within our education playlist.
So here you have it. This is to cover the difference between net yield and gross yield. You can see that the net yield is the true return which we should always look at when purchasing an investment property. Chapter number 2 will be the next one. I suggest you subscribe to our channel so you can keep up to date when it comes available. And in chapter number 2 we will cover cash on cash return. What is cash on cash return? So keep up the good work, and we'll see you in chapter 2. Cheers.